Hey guys, welcome to this week's podcast episode. And I've got a fantastic guest for you today. Very timely and relevant. Michael Tanner in the oil and gas industry in a time where there's so much economic uncertainty and volatility in markets. I'm really happy to have him on the show and discuss his thoughts about the oil and gas industry. So Michael, welcome.
No, Dr. Christopher, really appreciate you having me on. We really enjoy listening to you and how you do a really good job in my view of covering all different aspects of kind of the finance space. Just focus on one specific sliver. So I'm excited to come on and talk a little oil and gas with your audience. This will be real fun.
Yeah. Introduce yourself, who you are, what you do, your firm. And I'm really excited to dive into the conversation.
Yeah, absolutely. Obviously, my name's Michael Tanner. Work for Pecos Country Operating and Trevino Resources. Engineer turned finance guy. So I don't know if that tells you one way or the other about my engineering skills. Worked for a couple of years actually up in Cody, Wyoming for a super major oil company. They owned a field just south of Cody, Wyoming. That's where I live, but the field was actually 20 miles south. Gorgeous area, man. If I could retire somewhere right outside of Yellowstone, I would. Winters did suck, though. I'll tell you that much. It wasn't too much fun working outside in the winter. Made my way back down to Denver, where I'm originally from. I went to college out there, moved into more of the equity research side of things, and then migrated after going back to graduate school more into the traditional finance role. Been doing that for a bunch of different oil and gas companies now throughout my entire career. Been with Pecos and Trevino family for about 2-ish years now, mainly focusing on kind of that hybrid line right in between where corporate finance and engineering meet. And just, again, really excited to talk. And it really, I think the thing that's really timely for your audience is that Pecos and Trevino, we really found ourselves in a position where we've been able to help a lot of high net worth W-2 individuals with oil and gas, specifically on the investing side, due to the fact that there's a pretty unknown but massive tax benefit to actually investing in oil and gas, specifically from a W-2 side. So it's been really cool to be able to help people out with that. And yeah.
Yeah. And so to set the stage, are you an analyst or are you a trader? Or are you founder at the firm that you are currently at? Just so I can know how to tailor the questions for the audience.
Absolutely. No. So I'm the
Yeah.
CFO. The CFO there, deal with pretty much anything from FP&A, investor relations. They're a small family-run organization. I'm actually one of the first hires outside of the family, so really honored to help wear that mantle. But pretty much anything from analysis, FP&A stuff, accounting. I wouldn't say accounting is my strength, but man, it's the language of business. So you got to know accounting like at the back of your hand. And then I'd help out a lot on the engineering side. Again, I'm a former engineer in my past life, so I don't proclaim to be an engineer per se, but definitely helps me in my current role.
Yeah. So my follow-up question is for the firm, how do you invest in oil and gas? Is it through actual physical acquisitions? Is it oil wells? Is it through equities? Just set the stage for the audience.
Absolutely. So we're an oil and gas operator. So this is all direct into the oil and gas business. We're not an equities fund style house. We do offer specific oil and gas funds, but those funds are designed to directly buy interest in producing oil and gas assets. We really like to think of ourselves as the closest way to expose yourself to the energy business, if that's what you're looking to do, by going out and actually just going straight to the wellhead.
Yeah, it's very similar to prior guests, and the reason why I ask is because I see the indices in the background, and I see your screens up there. So I was just wanted to make sure see if it was more from the trading aspect. I was gonna ask about the markets today, and how has the oil and gas industry evolved over the last decade, and how has your position and what major changes do you foresee in the next 5 years?
I think from an oil and gas standpoint, we could spend hours talking about what's changed. And I think to bring it home and talk about the big questions that the oil and gas business is grappling with right now is one is consolidation and M&A. If you do follow the markets at all, you've been hearing for the past 18 months, Exxon buys Pioneer, Diamondback buys Endeavor, all of the big mergers that are happening. And that's really been a theme, and it's a lot to do with this idea of economics of scale. It's gotten to the point where oil and gas companies are struggling with, at the large level, finding enough quality inventory to be able to drill economically enough in order to maintain their current balance sheet. Oil and gas companies used to be some of the most levered businesses out there from a debt standpoint. Ever since kind of the 2016 to 2018, what I would call shale bust, investors and capital markets have really swung the other way with oil and gas companies and said, nope, we are not going to reward you for being highly levered. We're going to reward you for stock buybacks. We're going to reward you for dividends. And we're going to actually look to turn a profit. We don't just want you to drill, baby, drill, as some of the phrasing we've heard. So as we've moved into this more volatile go for market, I think a lot of people in our industry have been prepping for this. One of the big ways to maintain status quo is, and the real question that they're grappling with to maintain that status quo is, do we go drill a new oil well or do we buy existing production? And what is actually more profitable? And I say profitable, looks better on a balance sheet and is going to attract that more institutional capital. From 2012 to 2016, really from 2008 to 2016, institutional capital loved oil and gas, loved it for reasons that maybe right now don't make sense to us. There was big dividends were getting handed out. Balance sheets looked like they were growing in terms of proven oil and gas reserve. But sometimes when you can't convert that balance sheet into actual returns for your investors and shareholders, things can get lopsided a little bit and the industry can flip and say, okay, now I don't really care so much of how strong your balance sheet is as so much as how am I convinced you're going to be able to, on an institutional level, return capital to investors. A lot of debt got wiped out. We saw a pretty big consolidation around that point. And what we're dealing with every day right now is the continued consolidation. We saw two smaller mergers happen last week. Probably didn't make CNBC up there behind me, but definitely have been shocking, especially that Dallas-Fort Worth region that I'm in. So I would say that's really the big question. And then as we sit here today, prices have drifted from where they were over the summer at about $80 to somewhere here in the high 60s. The real question that I think a lot of big, large operators are going to be asking themselves is what inventory, and I mean inventory, new wells that we could possibly drill, where exactly do they fit profitably along that cost curve? And if we drill a well now, what's that going to look like in the future? And I don't want to skew too far off, but oil wells decline. You drill a well, you're going to produce the most amount of oil in the first couple months, and then it's going to slowly decline. It'll eventually settle out. So the real question these companies ask themselves is, are we going to be able to make our money back early enough? Because if we don't, we may never make it back because of the natural sort of decline of the individual asset. So I know I threw a lot out that, but I think those are the two big things that are being grappled with right now. And I think that trend we'll see continue, at least for the next couple of years.
Yeah, really interesting. And I was going to ask you about your thoughts and perspectives on how we're transitioning into energy and electric and how your firm views that and is positioning. Obviously, it's still oil and gas and also natural gas. So my next question to you is, because a lot of the audience, legacy audience, are high income, high net worth, doctors, lawyers, dentists, and traditionally the asset class that they've been really interested in is real estate. Talk about your perspective from the oil and gas, how to diversify a portfolio, advantages compared to real estate, all of that.
I think the first advantage, if you're a high net worth W-2 individual, is the fact that oil and gas, specifically drilling new wells, offers the IDCs and the ICCs. So IDCs are the intangible drilling costs. ICCs are intangible completion costs. All of those costs, basically the entire cost of drilling a new well, is 100% tax deductible in terms of both passive income and earned income, which is also awesome. It's not just the passive income you'll make on a specific oil and gas investment. It can also be rolled back into your earned income as well, which is why specifically we have a lot of doctors, dentists, and lawyers who like to invest in our projects mainly for that tax deduction part. Because when you look at an entire oil and gas project, we're just in the middle of drilling 4 new wells and reworking 10 old wells, which is, you can think of it as a rehab job for real estate. Forgive me if I make a terrible real estate analogy. I dabble in real estate a little bit, but I'm not the expert like you and your audience. But drilling a new well can be considered a ground up development project. A rework can be considered you're kind of rehabbing the existing building. The rehab on the existing project, actually only a small portion of that capital outlay is going to be able to be tax deductible, maybe 30 to 40%. But those new wells, 100% of those drilling and completion costs are tax deductible, which means that as an investor, those roll back into you. So we like to tell people on an average project that we do, specifically, let's just look at this 4 and 10 that we're doing, because I'm deep into that right now. We are We pitch about 70% tax deductions overall over the life of that project on that first year. Probably will end up a little bit higher than that. I've worked for a few different oil and gas companies who can get it up into 80, 85%. There are just some things that aren't tax deductible. You go out and you got to buy land. Salaries from a G&A standpoint aren't tax deductible. There's other things around it, but the majority, specifically if you're talking about kind of an oil and gas drilling project, it's what I would say is the main benefit. And then I think the other benefit, at least in today's specific market, is the arbitrage between where oil prices are and where interest rates are in terms of your potential return profile. I just got done talking to you about how oil prices have slipped. That doesn't necessarily affect an investor as much as it does the oil and gas company from the standpoint of you're still going to be receiving that monthly revenue if you say invest in an oil and gas project. From the operator side, it could make it a little bit more tricky, but you as what I would call a limited partner, or we consider working interest partners. That's the actual definition, because the projects that we do aren't necessarily fund styles where it's a traditional GP-LP relationship. We actually sell you a physical percentage of the project and you own that. That's yours. You can go sell that to somebody else without talking to me, without talking to Trevino. You can hold that. If we decide to sell the remaining portion that we own, let's say we own 30% of the project and we've sold 70% off to smaller interest. If we want to sell our 30%, but you don't want to, or you think the valuation is too low, what we're saying, you can keep it. You're in direct control, and it also allows those tax deductions to roll back. So we go that direct working interest route because we think it cuts through the noise a little bit. It also shows you it makes it more analogous to real estate because we're actually showing you the project that you're investing in. Some of these oil and gas funds can get a little bit black boxy where you're saying, well, we're raising a $25 million fund to go do some stuff. What stuff are you going to do? We're not really sure. Whereas as you're familiar in real estate, when you see a term sheet, we're going to go buy this apartment complex. Here's the cap rate. Here's what the returns look like. And so that's really what we've tried to model with this kind of direct working interest route.
Yeah, really interesting. And also shifting gears a little bit, now the audience kind of gets a good feel. They're investing in a fund and you're going out and doing all these investments and tax advantages for the investors. One thing is increasingly there's a focus on sustainability and the environment. And how is the oil and gas industry adapting? And what role do you see traditional energy sources and your firm playing in a greener future?
So one, I would say the United States produces the cleanest barrel of oil and the cleanest MCF or million cubic feet of gas anywhere in the world, whether it's onshore or offshore. So there's no better place if you're interested in making sure we've got the lowest carbon emissions. That's happening in the United States, bar none. So from that standpoint, we just have a massive advantages. There are large amounts of regulations on what oil and gas companies can do from a flaring standpoint, very stringent regulations on spillages, leakages, all that. And generally at a company our size, the last thing we want to do is be spilling, not just because it's bad for the environment, because that's oil that we would like to sell through the tanks. In terms of kind of the transitioning to you talking about the more sustainable, I personally, and this is me speaking just personally right now, not necessarily for Trevino, but I would wager to bet they would agree with me, is the fact that natural gas is going to be the transition fuel to the future. Right now, the grid can't sustain 100% renewable. Even if we were able to have all wind and all solar, the grid isn't ready to handle all that right now. So the question is, if we do want to move to specifically an electric vehicle market, which I think trends are moving that way, we're going to need some other way to generate all that electricity, and natural gas being much, much more sustainable. You think about it, we burn natural gas in our homes via an open source natural gas flame. No one's necessarily worried about the emissions there because it's definitely in smaller quantities, but that is a much, much more carbon non-intensive method than say oil, and then even coal, and then going back thousands of years ago, fire. So we've always as a society trended downward. Natural gas, we've seen with LNG becoming a huge, almost national security risk throughout the EU, as we've seen with the whole Russia-Ukraine conflict and then blowing up Nord Stream. Energy prices have skyrocketed in Europe. So we really feel, and I really feel, that natural gas will become that transition fuel to the future. And what comes after natural gas? If I knew that question, I probably wouldn't need to be on this show here with you. I'd be with Richard Branson over on Necker Island just hanging out. But that's really where we are focused on, at least from a sustainability standpoint. We do the majority of our investments right now, and the wells that we drill are primary oil wells, mainly due to the fact that the superior return profile right now is oil. But natural gas, as we move down this cost curve, is going to become more important. And I think is that bridge to the sustainability future that you talk about.
Yeah, really interesting. And there was another guest also in the oil and gas, and he was talking the same thing. Natural gas is booming now and acts as that bridge that you were describing. The next question I have for you is this is really timely. This is September 6th and the jobs report, and we have markets crashing. I was curious, how does market volatility and fluctuating oil prices and what's going on in the market, interest rate? I think they're trying to see when it's about a week out before the Fed announces what the next interest rate is. And so how does that affect what you're doing, your company, with all of the price of oil, the volatility and all of that?
So at our company specifically, we don't use debt at all. We have no outstanding credit facilities. We don't leverage debt at all. We don't even have credit cards. Everything we actually do is in cash. It's the family style business, which can present challenges for me being a finance guy. But hey, we work within the constraints we are given. So we're less concerned about interest rates and more concerned about, on average, what's the trend of the oil and gas space. And we are not a large public company. So I went through that whole spiel about oil and gas companies are grappling with how much inventory do we have that's profitable. The economics that an ExxonMobil has are going to be different than what we have. ExxonMobil needs to go out and drill a well, and they need to make 5, 6, 700 barrels of oil a day in order to make that well profitable. For us, and when I talk about that 4 and 10 project that we're doing, the 4 new drills and the 10 reworks, we're forecasting 20 barrels a day per well. So the cost to actually go drill that well is so far lower than a large oil major that it gives us a lot of running room. We also sell our oil on an average per month basis, meaning whatever the average of oil and gas prices are over the month, that's what we receive from our first purchaser, which is what they're called. Whereas if you're producing 5, 6, 700 barrels a day, you're selling that oil, whether you're trucking it out, which is 4, 5, 6 loads a day, or whether you're putting it in a pipeline, you're receiving that spot price. So you're actually, as a larger company, a little bit more sensitive to the day-to-day swings of oil prices are than some of the smaller operators, which ironically, about 90% of the oil that's produced in the country is produced by companies that are producing less than 1,000 barrels of oil a day, which would be considered small in the oil and gas business. So ExxonMobil gets a lot of time on CNBC. Pioneer used to got a lot, but they really only make up about 10% of the overall oil and gas production that goes on in the United States. And a lot of it is done by these smaller firms such as ourselves. So those two things a little bit naturally insulate us. Obviously, a larger trend of falling oil prices is going to hurt everybody. But I think it's one of the big reasons we do a really good job of underwriting our deals at significantly lower oil prices than what strip oil prices are. Strip oil prices are is basically you can go out and buy futures for oil. You can buy futures next month, the month after that. You can buy futures for months 2 years out. And if you plot all of those on a chart and connect a line, that's what's called like the futures strip price. And so what we do is when we go to underwrite a deal, we take the strip price and we discount it 20, 30, 40% and run all of those different sensitivities. And if we can't at least get people a positive return at 40% below where current strip prices are, then the project's not for us. Luckily, we have the ability with being the operator as well to control the costs because we could produce a little bit less oil than we forecast. But if we spend a heck of a lot less money to go get it, we can still make money because at the end of the day, it's how much oil are you making versus how much is it costing you to actually go get that? Because from that standpoint, so there's a few different levers, and that's the beauty of having both, we call it our family office, which is Trevino Resources, but then also our own operating company, Pecos Country Operating, to be able to control all aspects. It would be, again, I'm going to make a terrible real estate analogy. It would be like having your traditional family office, and then you actually own the development company that's going to go kick the dirt around, go buy all the wood planks to build the apartments and put on all the doors and do all that stuff. So we have the ability to leverage, though, at a small scale. I say we're small, but vertically integrated, if that makes sense.
Yeah, that's really interesting because I was just in my mind is just with interest rates and the economy and with markets. I was just curious how that impacted your company or business. Obviously, I'm in the real estate, so I understand. The next question I have for you is, what is the impending possible administration change, or if I can't, I hate to see another 4 year Democrats, but what is the possible regime change and how will that affect the oil industry and your company?
And this is really interesting because this is stuff that I don't want to say gets talked about in dark rooms, but nobody really wants to admit this in the oil and gas business. Everybody in the oil and gas business, I'm not breaking any ground here, and no one's going to be shocked when I say the oil and gas business would love former President Trump to get reelected. They would love it. There's going to be less regulation. He's on stage at the RNC saying drill, baby, drill. But if you actually go back and look over the 4 years, and you can actually do this if you plot oil prices and then plot just Democrat and Republicans in office from the White House standpoint, if you go back, say, all the way to Jimmy Carter in 1980, Democrats have significantly higher oil prices relative to their Republican counterparties. And it's this interesting conundrum that I think people in the oil and gas business know, but don't want to admit that it would be great to have less regulation. We might be able to get access to more federal lands to drill. We might be able to have, speaking about specifically offshore, all that is federal leasing. And so when Democrats are in power, generally there's less ability to go lease a lot of that federal land, or there's more restrictions on that. The cost to go drill a well will go up, not necessarily because the physical inputs are higher, but because the regulatory regime around it is more expensive. But that naturally restricts supply. And again, oil prices are really, there's only two things that move oil prices: supply and demand. Now, a lot of it is what people think supply is going to be and what people think demand's going to be. That's a little bit about actually what we're seeing right now as we record this. It's not so much the current supply and demand, it's what people are forecasting future supply and future demand to be. So if it's harder to drill, that means less companies are going to do it. It means that future demand or future supply might go down. And as long as demand continues to steadily increase, which it will, people are going to still drive, people are going to still need electricity. We're still going to need all of these things that we don't quite have the ability to replace with renewables. We'll roll that all in, and things are changing a little bit, but not fast enough relative to where demand's going. That is naturally just going to, as an economist, my master's degree is in economics. It doesn't take me to tell you that just prices are naturally going to rise because of that. So it is this interesting dichotomy that you see in the business of they would love Trump to win, but if Democrats stay in control, you will probably see this. And I don't want to make a prediction, but as we sit here on September 6th, this will probably be lowest oil prices will be in the next 4 years relative to that, just because of the different types. We've seen Kamala Harris come out and say, we're going to ban fracking. She's not going to ban fracking. Here's in my opinion, the dirty little secret is they're not going to ban fracking, because you ban fracking, prices go to $150 overnight, literally overnight, because that will completely cut off about 50 to 60% of all U.S. domestic oil and gas production. And so she's clearly changed her tune on that a little bit. As we saw, she was for it, or she was for the ban. Now she's come out against the ban. And I think people are here like, hey, it's great to talk about, but if you actually were to do this, here's some of the implications. So it's a really interesting question you ask. I think there's people that would come down on both, but it really is it's a conversation I think people are a little not as willing to come out and maybe say publicly, because it puts them in an awkward situation.
Yeah, really interesting conversation. And so how can people find out more about you and reach out to you and check out the work that you and your firm are doing and learn more about you?
Yeah, absolutely. First, again, I appreciate you let me come on and chat a little bit. You can check us out at pecosoperating.com or really trevinoresources.com. You can also go to trevinoresources.com/invest if you're at all interested in seeing our prospective deck that we have. I'll put my contact, I'll give you my contact info so you can throw in the description or whatever. Anyone's more than welcome to find me on LinkedIn, reach out. Love talking to people just about the industry in general and specifically about some of the projects that we may have. It's really fun, man. We could spend hours talking about this. So I really appreciate it.
Yeah, I really love your energy and enthusiasm. And thanks so much for a timely interview. This interview will go out probably tomorrow or this weekend. And
Awesome.
Thanks so much for coming on.
Absolutely. Again, really appreciate it. Thank you for having me on. And hopefully we can, maybe after the election, we'll have to do this again and see if some of these predictions were right.
Yes, yeah, that'll be it'll be very interesting to see.